AAAFx, this is Christopher Lewis taking a look at the upcoming week of March 11th. First thing I'll do, as per usual, is go through the economic calendar and give you a heads up as to what you should be watching out for. This coming week, nothing on Monday really is going to be moving the markets from a planned point of view. Obviously, there's always the possibility that we will see some type of surprise announcement, something over the weekend, etc. But I don't necessarily expect that to be the case. Keep in mind that in North America, the daylight saving time shift happens, so they spring forward an hour. That, if you're in Europe, might cause a little bit of strangeness in your announcements. Same thing with Asia, but just keep in mind that America has moved forward an hour next week. Okay, so again, Monday, not a lot going on. New loans in China could be something to pay attention to, but they don't necessarily announce it on Monday. It's just sometime during the week. It's one of those obscure announcements that can give you an idea as how the Chinese economy is functioning. It's probably not something that's tradable by itself, but you never know. If it's a huge miss, that might capture people's attention. So on Tuesday, we get down to business with the British and the claimant count change, or the unemployment claims number. And it is expected to be 20,300. If it's higher than that, that's obviously bad for the pound and the FTSE. But if it's lower than that, that is actually good for the economy. I think more importantly, we'll focus on CPI in the United States. Now, this typically is a market moving event. We'll have to see how this plays out, because Jerome Powell really took a lot of the wind out of the sails of this announcement this previous week as he testified in front of Congress and pretty much assured them that there would be rate cuts sometime this year. Really, at this point, it's a matter of the timing. And if the CPI comes in hotter than expected, that pushes these rate cuts out. It tends to put downward pressure on stocks. It will be short-lived, could put upward pressure on the dollar, that type of thing. The 10-year bond auction in America really doesn't normally move things unless they have to pay a much higher rate, for example. It's expected to come in at 4.09. We'll have to wait and see. 2.6 times subscription is anticipated. Generally not a big mover unless it's a huge miss. And pretty localized to New York Stock Exchange type trading, Nasdaq 100, etc. Wednesday, we get GDP out of the UK month over month. This obviously will have a major influence on the FTSE and the British pound. Pretty quiet day for the rest of the day. We get some bond auctions coming out of Germany until we get the 30-year bond auction in the United States. Again, this is one of those things, as long as it's close, it generally doesn't make any difference. 4.36% is expected with a 2.4 oversubscription. So going into Thursday, we get another announcement slew coming out of the United States. We get PPI, Producers Price Index. It gives us an idea as to what inflation is doing in the producing part of the economy. And of course, we have core retail sales. That's going to be the one that's sticky. It's always sticky. If there's one thing that Americans can do, and I live in America, it's buy things. So this is going to be where the Fed really struggles to get things under control. Retail sales, of course, that includes auto and some other things. That's the actual difference. Core retail tends to be the one that most people pay the most attention to. And then, of course, we get the weekly unemployment claims number coming out on Thursday at the same time. 218,000 jobless claims expected. We'll have to see whether or not that holds. The higher the number is, ironically, that might be better for the stock market. The people on Wall Street want to see less Americans working. That means the Fed has to act. The stock market isn't a reflection of the economy. It's a reflection of how money's traveling through the system. Huge difference. Friday, you get the Empire State Manufacturing Index. The worse it is, the better for the stock market. And then you get University of Michigan Consumer Sentiment, which can move the market, but quite frankly, you can't read too much into it most of the time, because what we've seen over the years is that consumer sentiment will say one thing, but people will go out and buy anyway. So I think over time, it's going to become less and less important. With that, let's take a look at some charts. The US dollar spent a majority of the week plunging against the Japanese yen, mainly driven by Jerome Powell suggesting that there will, in fact, be rate cuts later this week, or later this year, excuse me. I don't necessarily think this is something that's sustainable, mainly because you lose money you have to pay to hang on to a short position. I think it's very likely that we pull back to the 145 yen level where buyers come back in. We are in the midst of a bit of a ascending triangle. If we break down below this trend line, obviously that changes things, but I can think of at least 6 or 7 currencies I'd much rather own than the Japanese yen against the greenback. S&P 500 had a pretty choppy week. Looks like we're trying to eke out a slightly positive candlestick, but even if we don't, doesn't really matter. At the 5,000 level now should end up being significant support going forward. This is a market that continues to bank on cheap Fed money, and the Fed out there pumping up assets, working against themselves for some reason, does suggest that we will continue to see FOMO. Nasdaq 100 had a little bit tougher week, but again, ended up forming a bit of a hammer. So what this tells me is we are still very much in that buy on the dip attitude that we've been in for some time with the Nasdaq 100. Remember, the Nasdaq 100, much like the S&P 500, is driven by just a handful of stocks. It's become an ETF of about 6 or 7 stocks. So therefore, you can't read too much into what some of the smaller companies are doing. As a matter of fact, they don't even register on the chart anymore. With this, the market is overdone. I recognize this. The market's been overdone for a long time. There isn't a whole lot you can do about it. You either buy dips to find value or you stay on the sidelines. The Australian dollar has rallied pretty significantly during the week, but as I flipped it to the daily chart, this is not the most confidence inspiring candlestick for Friday. So we'll have to wait and see how this plays out. It looks to me like we're going to pull back into this area. The question now is whether or not it holds. The 0.65 level and the 0.69 level, I think, are your 2 major areas that you're paying attention to. The euro had a pretty significantly bullish week, reaching towards the 1.10 level. But again, on Friday, looks like maybe a little overdone. Could be ready for a pullback. I think the Aussie and the euro are going to be similar in the sense that right now it's probably more likely to stay in the overall range that we've been in. And that is especially true with the euro dollar because number one, it typically doesn't travel very well. And number two, Germany's already in a recession. So it's only a matter of time before the ECB follows the Fed. The crude oil markets had a negative week. Not as bad as the candlestick looks. We just kind of chop back and forth. So what does this tell me? This tells me that if U.S. oil can break 80, it can really go higher. Over here in Brent, it's 84.50. You look at the daily chart again, it's more choppy sideways. So I like oil. I continue to like oil. I think there are a lot of reasons to believe that it rallies, not the least of which would be geopolitical concerns in the Middle East, but we also have concerns about supply, which is somewhat tight. And if central banks around the world are going to start cutting rates, that is going to drive up demand for energy as traders will bet on industry revving up its machines. So this is gold. We've hit the area that I had talked about earlier in the week as a measured move. Matter of fact, we're stopping right there. The daily candlestick, to me, I mean, we're getting tired. The question is, when do we run out of the FOMO? And that's the hardest part of this. More likely than not, we will see a pullback. That pullback will, more likely than not, get bought into. The ideal entry is 2075, but we'll wait to see whether or not we get that. This is going to be all about geopolitics and the yields in America. If the yields start to slip a bit even further, then it will drive gold higher. On the other hand, if they do pick up, meaning yields rise in America, that could put downward pressure. Silver, same game here. $24.50 offering resistance. It certainly looks tired on Friday. A pullback in silver makes a lot of sense, but I also think that there are plenty of people underneath that are willing to get involved in silver to keep it afloat. Now, keep in mind, silver is a little bit different than gold, mainly due to the fact that it's also an industrial metal. So, central bank easing could end up making silver a winner longer term. However, do not get sucked into the narrative of a lack of supply. I've been trading for 16 years now, and that's a story I've heard the entire time. And I can assure you, uh, the market, the paper market, which is what you're trading, ignores that. Whether it should or not, completely different conversation. So don't get sucked into that narrative. I think we stay in this range between 22 and 26 for the foreseeable future. A pullback offers value. If we can get a dollar drop, that would be excellent. Bitcoin continues to probe all-time highs. Obviously not a market you can short. The daily candlestick ended up being a little bit positive, but this is definitely a market that is reaching above its skis and beyond its skis, meaning that a pullback is more likely than not. This isn't normal behavior. The last time we saw this in Bitcoin, we had a big collapse. Is that what's going to happen this time? Probably. The problem, of course, with Bitcoin is you never really know when it is. It comes down to whenever Wall Street pulls the rug on its ETF, and they will. That's what they do. They sell things to retail traders who don't know any better, people who are chasing all the way up here, and then they say, "Here, hold my bags," and you hold their bags, and you dump here, you get out of your position here, you take a huge loss, and then they look for a time to buy it when it's extraordinarily cheap. That being said, it doesn't mean that a pullback means we're going to fall apart. What it means is you need a pullback to even consider. You can, of course, do whatever you want, but um, you know, it's up like 80% this year, 75% this year, and it just turned March. So you tell me, where's the value? The US dollar against the Canadian dollar continues to be stuck in a range 136, 1.3620, and down here at 1.3380 continue to be the boundary. Not much to say other than we are essentially stuck. Dollar Swiss was trying to break out to the upside. We'll have to see how this plays out because this ended up being a very interesting candlestick on Friday. I think we make a run towards 89. If we take that out, that would be a very bullish sign for dollar Swiss. What's interesting is look how pound Swiss ended up. It just continues to go higher, and I really like the look of this chart. I think this is a market that will eventually go looking to 115, short-term pullbacks, buying opportunities. DAX looks like it's getting a little toppy here, got a little ahead of itself. A pullback would make a certain amount of sense. Also would end up being a buying opportunity. 17,600 is an area I'm watching. The FTSE 100 continues to languish sideways, and until we break the 7,800 level, I'm not doing anything with it. Yes, you can trade it back and forth, but it is just so choppy. It's probably more frustrating than anything else. Dow Jones 30 finished the week with a hammer. This tells me we are more likely than not going to continue the buy on the dip behavior in the Dow Jones 30. That's fine. Whatever. It is what it is. It doesn't matter what the economy's doing. Just pay attention to what price is doing. The British pound has broken out to the upside, and that's part of what you're seeing against the franc. We broke out against the dollar, and that could give you a buy on the dip opportunity here, especially anywhere near 1.2750. We'll have to wait and see, though, because things really did close a bit suspect on Friday. Nikkei 225 has discovered gravity over the last couple of days. When you look at the weekly chart, it is a bearish, almost engulfing candlestick. I think we're getting ready to set up for a pullback. That's a good thing. Again, markets can't go in one direction forever. Dollar fell against the Mexican peso. Here's my spot right here. And I might even bring it back because I think it's more or less a zone. So let's just say 16 and a quarter pesos. We're right here into the area where the support's going to be. So if we find support and the dollar takes off, this is where it's going to happen. Very interesting chart. Not a lot to do right now, though. Euro Swiss broke out for the week, but it did pull back. Daily candlesticks, though, show a different story. So it looks like we are going to continue to rally against the franc. Ethereum looks really strong. The candlestick on Friday, not so much. It looks like we're ready to have a pullback, but how many days in a row do you expect it to go up? We'll have to wait and see how that plays out, but it certainly looks to me like a market that you can't short. You're looking for value. The CAC the weekly chart, looks very positive. We broke 8,000. That was the next 100 level. Quite frankly, this is a market that I just don't see how you short. It looks really good. When I go to the daily chart, you can see we did stall a little bit on Friday. That's fine. I'm looking to buy on a dip again and just take it from there. And then finally over here in Litecoin having a week. We fell pretty hard, but look at that recovery. That's a really good sign. You can see that the session on Tuesday really fell apart and then turned around. So that's a sign of underlying demand. We'll see if we can get to 110, but that certainly seems to be the target in the short term. That was a look forward to the March 11th trading week by AAAFx. And if you enjoyed this, give us a thumbs up, subscribe to the channel so that you can catch not only our weekly forecast and week ahead video like this one, but you can also catch my daily analysis videos in various markets around the world.